Bhagyashri Kelapgavde, and I'm here to present on the topic mergers, acquisitions, and corporate restructuring. This presentation dives deep into the strategic, financial, and operational aspects of merger and acquisition and restructuring activities. From understanding their types to examining real-world case studies, we'll explore how companies use these tools not just for survival but also for accelerated growth in today's dynamic market. So moving forward to the first slide. Mergers, acquisitions, and corporate restructuring are powerful strategic tools. A merger is when two companies combine into one new entity. This is typically done to expand market share, create synergies, and streamline operations. Acquisitions, on the other hand, involve one company taking over another. Here, the acquiring company gains control and integrates the target's operations, often for strategic expansion or cost efficiency. Corporate restructuring refers to major changes in the company structure, ownership, or operations to improve efficiency, reduce risk, or survive financial hardship. These actions are not merely financial, but they are about strategic realignment to respond to new opportunities or changes in the business environment. Moving forward to the next slide, strategic business tools in modern corporates. Mergers and acquisitions are more than financial transactions. They are strategic tools that align with long-term goals. Companies adopt these strategies to quickly access new markets, technologies, and customer segments. In a competitive, fast-evolving business world, firms must act swiftly. Mergers and acquisition often offers faster returns compared to building capabilities organically. For example, a tech company might acquire a startup to innovate faster, or a telecom firm may merge with another to gain dominance. It's important to understand that these moves are part of broader business transformation strategies, not just balance sheets and adjustments. Now we'll come to importance in the modern business world. Uh, so why are mergers and acquisitions are so prominent today? Three main reasons are as following. First, globalization. Companies face fierce global competition and need to consolidate to remain strong. Second, mergers and acquisitions open the door to new markets, technologies, and resources. Third, operational efficiency. Mergers can reduce duplications, share costs, and improve performance. A perfect example is Facebook's acquisition of Instagram. These deal reshaped the social media industry, helping Facebook secure dominance. These strategic move, give companies the edge to grow, adapt, and lead in the modern business world. Moving forward to the next slide, key definitions of mergers, acquisition, and restructuring. To build a strong foundation, let's define three core terms. A merger is when two companies join to form one. Think of it like hello. In contrast, an acquisition is more like one company taking ownership of another. It's a buyout where control and decision making lie with the acquiring firm. Corporate restructuring, meanwhile, is about reshaping an organization structure. This might include spinning off parts of the business, changing financial structure, or altering management hierarchies. This process helps companies survive crisis, boost profits, or reposition themselves in the market. Next slide is objectives of mergers and acquisitions and structure restructuring. Merger and acquisition and restructuring are done with clear strategic objectives. First, expansion. Companies may want to enter new market or product line. Second, economic of scale. By combining operations, firms can reduce per unit cost. Third, increasing market power. Companies become stronger and more influential. Fourth, eliminating competition. Acquiring or merging with competitors reduces market rivalry. Other goals include improving financial health through restructuring and ultimately increasing shareholder value. The objective isn't just growth, it's smart, sustainable, and strategic growth. Next slide is historical evolution of merger and acquisition. Mergers and acquisitions have a rich history, evolving through distinct waves driven by economic and legal shifts. Understanding these waves will help us predict future trends. The first wave, 1897 to 1904, was about horizontal mergers. Companies combined with the same industry to form monopolies like US Steel. The second wave was 1916 to 1929, featured vertical integration. Companies merged with suppliers or distributors. The third wave, 1965 to 1969, was about diversification, like forming conglomerates like ITT. The fourth, 1981 to 1989, saw hostile takeovers and leverage buyouts. The fifth wave, which was 1993 to 2000, was driven by globalization and technology, and the sixth wave, 2003 onwards, include cross-border mergers and acquisition and private equity dominance. Today, we are in the strategic tech era shaped by ESG and innovation. Moving further with this slide, major mergers and acquisition waves detailed overview. Let's briefly walk through the key mergers and acquisition waves in detail. The first wave was about horizontal consolidation to form monopolies. The second focused on vertical mergers, companies like Ford controlling the supply chain. The third wave emphasized diversification, building large conglomerates. The fourth was aggressive, filled with hostile takeovers, often financed through junk bonds. The fifth embraced global deals and tech partnerships. The sixth wave expanded into emerging markets with cross-border activity. The current era, since 2009, is strategic and tech-focused with an emphasis on sustainability and innovation. Understanding these waves helps us analyze the motives behind major deals today. Moving further to the next slide, which is global trends in mergers and acquisition. The mergers and acquisition landscape has become increasingly global. There's a surge in cross-border deals. Companies now think beyond national boundaries to achieve scale and access new customer bases. Technology deals are booming, with firms acquiring startups for AI, cloud, and digital capabilities. ESG factors, environmental, social, and governance, are also influencing deal structure strategies, pushing firms to merge with sustainable partners. Private equity buyouts are on the rise as firms seek value creation in new ways. Regional data shows North America and Asia's Pacific dominating mergers and acquisitions in terms of deal value. This global trend reflects a shift towards fast-paced, innovation-driven strategy. Uh, Now moving. to the next slide, which is Indian trends in mergers and acquisition. In India, the merger and acquisition story picked up pace post 1991 liberalization. Economic reforms allowed foreign investment and private competition. Sectors like IT, telecom, banking, and pharma are leading the charge. Think of the Vodafone Idea merger or the HDFC Bank deal. The government has also played a key role by restructuring public sector banks to build stronger financial institutions. Indian companies are now not just acquiring domestically, but also exploring international deals to expand their global footprints. The merger and acquisition environment in India is becoming more sophisticated, regulated, and strategically aligned. Now, navigating mergers and acquisitions, let's begin by understanding the journey through merger and acquisition. Mergers and acquisitions are not just one-time events; they are structured, multi-stage processes involving many stakeholders. This present the like This presentation will guide you through these steps from setting strategy and identifying targets to due diligence, deal structuring, approvals, and integration. Whether you, whether you are a student, a professional, or an investor, grasping these phases is essential. Why? Because each stage affects the deal's success. Many merger and acquisition fail not because the idea was bad, but because execution faltered and at one or more stages. So this journey is as much about process discipline as it is about strategic vision. The mergers and acquisition deal life cycle. The merger and acquisition life cycle starts with the strategic development, where a company defines why it wants to pursue a deal, perhaps for growth, take access, or synergy. Then comes target identification and valuation, choosing the right company and assessing its value using various methods. Due diligence follows, where financial, legal compliance and risk are examined thoroughly. Negotiation and deal structuring are next. Both sides agree on terms, pricing, and legal framework. Then comes regulatory approvals from bodies like SEBI or CCI. Finally, the most critical stage, post-merger integration, aligning systems and people and culture to realize the expected value. Each stage is vital and must be handled meticulously to avoid pitfalls. Moving forward to the next slide, key stakeholders in mergers and acquisition. Merger and acquisition involves a range of stakeholders whose interests must be carefully balanced. Management teams initiate the lead
It's
manage hello. Management teams initiate and lead the strategic direction. Shareholders must approve the deal as it impacts their value. Investment bankers provide advisory services, helping. Hello. Okay. Shareholders must approve the deal as it impacts their value. Investment bankers provide advisory services, helping structure and price the deal. Legal and regulatory authorities ensure compliance with corporate laws and competition regulation. Employees and unions are often affected in terms of job security and workplace culture. Finally, customers and suppliers are indirectly influenced by any change in service quality or business continuity. Ignoring any stakeholder can create friction and delay. So, clear communication and engagement are key to success. Now, we'll talk about the types of mergers. A merger occurs when two companies join forces to create a new entity. It's a voluntary agreement where both firms believe they'll benefit more together than apart. The key drivers behind a merger often includes enhancing competitiveness, entering new markets, or eliminating overlapping costs. Mergers can be domestic or international and may lead to a new name or the stronger brand absorbing the other. The intention is to create synergy where the combined company performs better than individual entity would have. However, for this to work, a leadership alignment, legal approvals, and cultural fit are all vital for a smooth transition. Now we'll see the types of mergers. Uh, Mergers are not one size fits all. They come in various types depending on the business goals. The most common type includes horizontal, vertical, and conglomerate mergers. Each serves a different strategic purpose. A horizontal merger consolidates competitors in the same industry. A vertical merger connects companies at different stages of the supply chain. A conglomerate merger combines firms from unrelated sectors, often for diversification. Understanding these types helps us evaluate the rationale behind each merger and assess its potential benefits and risks. Throughout the presentation, we'll go deeper into each type to understand how and why companies opt for them. Now we'll see the horizontal merger. In a horizontal merger, two companies in the same industry and at the same stage of production join forces. The primary motive is to increase market share and reduce competition. By consolidating, these companies can also achieve cost efficiencies and economies of scale. A well-known example is the merger between Vodafone and Idea in the India. It allowed them to pool infrastructure and customers to compete against Reliance Jio. However, horizontal mergers also raise antitrust concerns, as they can create monopolies or reduce consumer choice. Therefore, regulators choose examine these deals to ensure they don't harm market competition. Moving further to the next slide, which is vertical mergers. A vertical merger occurs when a company merges with another at a different level of the supply chain. Say a manufacturer acquiring a supplier or distributor. This integration allows company to control more of the value chain, reduce dependency, and improve operational efficiency. For example, an automobile manufacturer merging with the parts supplier can streamline production and reduce costs. Vertical mergers are typically driven by the need for better coordination, reduced transaction costs, and guaranteed input supply. They are generally seen as less controversial than horizontal mergers, but still need thorough evaluation, especially for integration challenges. Conglomerate mergers Conglomerate mergers involve companies from entirely different industries. These mergers are typically driven by diversification strategies where a firm wants to reduce its exposure to risk in a single sector. For example, a media company might merge with a fast food chain, seemingly unrelated but part of the financial strategy. While synergies might be limited operationally, these mergers can offer financial stability and broader brand leverage. They are often pursued by large businesses, groups, or holding companies looking to expand their portfolios. However, the lack of operational overlap can make integration more complex and benefits harder to realize. Moving further to the next slide, which is strategic objectives of merger. So mergers are undertaken with the clear strategic objectives. One, market expansion. Companies want to enter new geographics or customer bases. Two, cost and revenue synergies, reducing duplicate operations and increasing sales channels. Three, capability acquisition, gaining access to technology, talent, or intellectual property. Fourth, leadership positioning by eliminating competitors and increasing market share. These goals drive most decisions, but success depends on strategic alignment between merging firms. If the goals are mismatched or poorly defined, the merger may not deliver the expected results. So, clarity of purpose is essential right from the planning stage. Now we'll see advantage and disadvantages of merger. Mergers comes with both opportunities and risk. On the advantage side, they create operational synergies, cost savings, faster expansions, and enhanced market power. Uh, Companies can also share R&D, streamline processes, and improve cash inflows. However, disadvantages include cultural clashes, job redundancies, and integration hurdles. Sometimes the expected synergies never materialize. Legal and regulatory challenges can delay or derail the merger. There might also be resistance from shareholders or employees. Therefore, companies must weigh these pros and cons carefully and have robust integration and communication plans to ensure success. Moving further to the next slide, which is understanding corporate mergers, a comprehensive overview. Corporate mergers are multifaceted, touching legal, financial, strategic, and operational domains. This slide sets the tone for a deeper dive into the mechanics behind such deals. Mergers are not just headline announcements, they involve legal documentation, stakeholder approvals, financial modeling, and extensive planning. Each element must align for the merger to be successful in this section. We'll explore how mergers unfold from regulatory filing and tax implications to real-world case studies. Whether it's for market leadership, efficiency, or survival, understanding the inner working of mergers is key to navigate the modern business landscape. Now we'll see the legal process of a merger. Mergers follow a rigorous legal path to ensure compliance and transparency. It begins with board approvals and a thorough due diligence process to assess risk. Then shareholder consent is usually required, especially for listed companies. Valuation reports are drafted and regulatory filings are made. In India, the Ministry of Corporate Affairs, that is MCA, and the National Company Law Tribunal, that is NCLT, oversees the process. SEBI ensures investor protection for listed firms, while the Competition Commission of India, which is CCI, checks that market competition isn't harmed. Without legal clearance, even the most promising mergers can be blocked or delayed. Now we'll see the tax implications in the merger. Taxes play a crucial role in determining whether a merger is viable. When assets are transferred, capital gains taxes can apply, increasing the cost of the transaction. However, under the Indian Economic Income Tax Act, particularly Section 47, certain mergers are exempt if they meet conditions like continuity in ownership. Companies can also carry forward losses under restructuring provisions. Indirect taxes, such as stamp duty, can also be significant and vary by state. Proper tax planning ensures the merger is not only compliant but also efficient. Ignoring tax aspects can erode shareholders' value and make a well-planned deal financially burdensome. Now moving forward to the next slide, which is impact on shareholder. For shareholder, a merger can be both exciting and uncertain. They might receive new shares, cash, or a combination, depending on the deal structure. Ideally, the value of their holdings increases due to the expected synergies. But in the short term, volatility is common. Share prices may dip or rise based on market sentiment. Transparency is essential. If communication is poor or the valuation is perceived as unfair, shareholders may oppose the deal. That's why fair valuation reports, investor calls, and regulatory disclosures are vital. A well-managed merger should ultimately create a long-term value for all investors. Moving forward to the case study of Vodafone and Idea. The Vodafone Idea merger in 2018 was one of the biggest telecom deals in India, creating the largest operator at the time. It was a horizontal merger driven by the need to compete with Reliance Jio, which had disrupted the market with aggressive pricing. By combining their infrastructure and customer bases, Vodafone and Idea aimed for cost synergies and scale. However, integration challenges, regulatory pressures, and burdens made post-merger performance difficult. This case highlights that while merger can be strategically sound, execution and financial health remain critical to long-term success. The Moving forward to the next case study, that is Exxon and Mobil merged. In 1999, Exxon and Mobil merged in an $80 billion deal, forming ExxonMobil, the uh, the world's largest publicly traded oil company at the time. This horizontal merger was driven by falling oil prices and the need for operational efficiency. The deal allowed them to pool R&D, logistics, and global operations, achieving significant cost synergies. However, due to its scale, it faced intense regulatory scrutiny, especially about market dominance and environmental compliance. In the end, the merger succeeded because of clear strategic fit, strong integration planning, and cultural alignment, making it a benchmark case in the merger and acquisition history. Moving forward to the next slide, which is merger of SBI with associate banks. In 2017, the State Bank of India merged with five of its associate banks and Bhartiya Mahila Bank. and Bhartiya Mahila Bank. This government-driven merger aimed to create a globally competitive Indian bank. The goal was to strengthen capital adequacy, reduce redundancy in operations, and offer better customer service. By unifying systems and policies, SBI become more efficient and scalable. This deal is a great example of banking reform and public sector restructuring. While challenges like cultural integration and retaining staff existed, the merger was largely successful in consolidating India's banking sector and making SBI a more powerful player globally. Now we'll see the role of regulatory bodies in merger. Several regulators are involved in merger and acquisition uh, to ensure that transactions are lawful, fair, and competitive. SEBI oversees listed companies and ensures investor protection. The Competition Commission of India (CCI) ensures the merger doesn't create monopolies or hurt competition. The Reserve Bank of India, which is RBI, monitors deals involving banks with NBFCs, non-banking financial companies. The Ministry of Corporate Affairs (MCA) manages filings and administrative processes under the Companies Act. Lastly, the National Company Law Tribunal, which is NCLT, approves schemes of arrangement. Each regulator has a defined role, and delays in approvals can significantly affect deal timelines and market perceptions. Now we'll see the due diligence in mergers. Due diligence is the backbone of any successful merger. It's a comprehensive investigation into the target company's financials, legal risk, operation, and tax exposure. This process uncovers hidden liabilities and validates the true value of the business. There are four key types, which are a financial, legal, operational, and tax due diligence. Missing or rushing this step can lead to major post-merger surprises, from lawsuit to unrealized synergies. Due diligence helps the acquirer make an informed decision, structure the deal correctly, and negotiate from a position of knowledge. It's not just a checklist, it's a strategic necessity. Now we'll see the key success factors and post-merger evaluation. What makes a merger successful? First, strategic alignment. Both companies should share common goals. Second, cultural compatibility. Clashing work cultures often derail integration. Third, operational integration. System, processes, and teams must function as one. Fourth, communication. Keeping employees, investors, and customers are informed avoids resistance and confusion. Post-market evaluation is equally important. Tracking metrics like cost saving, market share growth, and financial performance helps validate whether the deal achieves its purpose. Without proper evaluation, companies might repeat the same mistake in future deals. Merger and acquisition is not a one-time event, it's an ongoing journey that demands strategic oversight. Moving forward to the next part, which is navigating mergers and acquisition. This section recaps the overall strategic importance of mergers and acquisition. Merger and acquisition isn't just about business growth, it's a transformative tool that reshapes entire industry. whether it's for entering new markets, acquiring technologies, or defending against competition. Companies use merger and acquisition to reposition themselves strategically. However, success depends on multiple factors, right? Uh, Transaction, target selection, proper valuation, and flawless integration. This strategy overview reminds us that while merger and acquisition may offer accelerated expansion, it demands meticulous planning, stakeholder alignment, and post-deal accountability. Every deal is unique and strategy must be customized accordingly. Now we'll see the post-merger evaluation, measuring success. Um, Once a merger is completed, it's crucial to assess whether it's delivered in intended benefits. Post-merger evaluation focuses on three major areas. First, financial performance. This is the company seeing growth in revenue and profitability. Second, synergy realization. Are cost savings and revenue boost actually been achieved? Third, market share. Has the company improved its competitive positioning? Evaluation tools and include KPIs, internal audits, and surveys. Without these steps, the company may misjudge the merger's effectiveness, measuring success, keeps management accountable, and also provides insights for future deals, ensuring continuous improvement in merger and acquisition strategy. Moving further to the next slide, which is success stories and examples of strategic mergers. Strategic mergers can create exceptional value when planned and executed well. Take the Disney Pixar merger. It combined creative storytelling with cutting-edge animation, redefining family entertainment. Tata Steel's merger with Chorus helped it expand globally and gain access and to high-end markets. ExxonMobil became a global energy leader by merging operations efficiently. The HDFC Bank merger integrated housing, finance, and banking, forming a financial uh, services giant. These success stories share common traits: clear strategic rational, cultural alignment, and strong execution. They prove that with the right foundation, mergers can lead to transformative business outcomes. Now we'll see the lessons from failed mergers. Just as we learn from the success, it's vital to study failures too. AOL and Time Warner merged in 2000, expecting media and internet synergies. Instead, cultural clashes and tech misalignment led to massive losses. Daimler and Chrysler is another classic example. Strategic mismatch and integration failure unraveled the deal. Quaker's acquisition of Snapple failed due to pure brand fit and distribution issues. In India, Jet Airways takeover of Air Sahara didn't yield the expected synergies, worsening financial strain. These failures teach us that overvaluation, misalignment, and lack of due diligence are fatal errors. Avoiding these mistakes is key to merger and acquisition success. Moving further to the next slide, which is merger, a powerful tool for growth. Mergers are powerful instruments for corporate transformation. They help companies expand into new markets, reduce competition, consolidate operation, and innovate faster. But they are not magic bullets. Success depends on the intent behind the deal and how well it is executed. Mergers can strengthen flow, enhance brand equity, and position companies for long-term sustainability. However, the risk like integration failure, cultural conflict, and regulatory barriers are real and must be managed carefully. When used wisely, mergers offer a strategic edge that organic growth alone may not achieve. Now we'll see what is an acquisition. An acquisition occurs when one company takes control of another. The acquiring firm either absorbs the target or allows it to operate semi-independently. Acquisition allow companies to expand quickly into new region, customer segment, or technologies. For example, Facebook's acquisition of WhatsApp gave it access to mobile messaging leadership. Acquisitions offer three key benefits: market access, product tech acquisition, and strategic control. However, challenges include valuation, disputes, employee resistance, and integration complexity. The acquiring company must ensure the deal is financially sound and operationally sustainable to, to truly benefit from the acquisition. Now we see the key differences between merger and acquisition. Though often used interchangeably, merger and acquisition differ in structure and implications. A merger is a typically a mutual agreement where two companies combine to form a new entity. An acquisition involves a one firm taking over another. In merger, control is often shared. In acquisition, control lies with the acquirer. Mergers are seen as friendly and collaborative, while acquisition can be either friendly or hostile. Legally, mergers often create a new entity, whereas in the acquisition, the target may cease to exist. These differences influence integration style, employee morale, regulatory approval, and public perception. Knowing the distinction is key to understanding the dynamics. And now we'll see friendly versus hostile acquisition. Acquisition can be classified based on consent. In a friendly acquisition, both companies agree to deal. This makes integration smoother as management team works together. An example is Microsoft's acquisition of LinkedIn. In contrast, a hostile takeover happens when the target resists and the acquiring firm bypasses management by directly appealing to shareholders, like Vodafone's takeover to management. Hostile takeovers often lead to internal resistance, legal battles, and negative publicity. While both types can succeed, friendly deals tend to have higher success rates due to better cooperation and cultural compatibility. Moving forward to the next slide, which is strategic reason for acquisition. So, why do companies acquire others? There are several strategic reasons. First is market expansion, entering new geographies or customer segments quickly. Second, diversification, reducing risk by entering new industries. Third, cost efficiency, reducing production or distribution expenses through integration. Other reasons include acquiring new technology, eliminating competition, and gaining access to specialized talent. Acquisition often offers faster growth than building capabilities internally. However, the strategic goals must be clearly defined and supported by thorough due diligence to avoid costly mistakes. Every acquisition must align with the acquiring firm's long-term vision. Now we see the process of acquisition. An acquisition isn't a single short deal, it's a carefully sequenced process. It begins with identifying the right target, followed by initial negotiation and the signing of letter of intent, which is allowed. Then comes due diligence, where the acquirer examines financial, legal, and operational health. After that, valuation and deal structuring take place, finalizing price, payment method, and legal terms. Regulatory review follows depending on the industry and location. The deal is then closed, and the most challenging part begins. Integration without a clear roadmap, communication, and early planning. Even a promising acquisition can falter post-deal. Now we'll see the due diligence in acquisition. Due diligence is the investigative backbone of any acquisition. It helps the acquiring company uncover financial, legal, and operational and reputational risks. Financial due diligence examines the target's revenue, revenue, costs, and liabilities. Legal due diligence checks for lawsuits, contracts, and or compliance issues. Operational due diligence ensures the business model is sound and tax due diligence confirms proper filing and identifies liabilities. The aim is to confirm that the target company is worth the price and doesn't have hidden issues. Skipping or rushing due diligence can lead to disastrous surprises post-acquisition. So it's not just a formal, it's a strategic safeguard. Moving further to the next slide, which is valuation methods of acquisition. Um, Valuing a company during acquisition is both an art and a science. There are several methods, each suitable for different contexts. The discounted cash flow, which is DCF, method regulates the present value or future cash flows based for stable cash generating firms. Comparable company analysis benchmarks the target against similar business in the industry. Precedent transactions consider valuation from similar past deals. Assets, asset-based evaluation is useful for firms with tangible assets like real estate or machinery. No single method is perfect. Using a combination gives a more balanced view. Accurate evaluation prevents overpayments, which is one of the most common reasons for acquisition failure. Moving further to the next slide, which is detailed valuation methods. Let's take a closer look at these valuation techniques, which is DCF focuses on projecting free cash flows and discounting them at the company's cost of capital. It's ideal for long-term investors but sensitive to assumptions. Comparable company analysis uses ratios like EV, EBITDA, PE, and CS to compare the target with peers. Helpful in benchmarking, but affected by market volatility. Precedent transactions rely on deal multiples from similar past acquisitions, but may not reflect current market dynamics. Asset-based valuation is often used in liquidation scenarios or asset-heavy industries. In practice, most merger and acquisition advisors use two or three methods for cross-validation. Financial modeling in this moving further to the next slide, which is financial modeling acquisition. Financial modeling is essential To assess whether an acquisition adds value, it typically includes pro forma statements that forecast the combined company's financials post-acquisition. Scenario analysis helps test various market and economic conditions. Accretion dilution analysis checks if the deal will increase or decrease the acquirer's EPS. Synergy estimation forecast cost savings or revenue gains from the combined operations. These models are built in Excel or specialized tools and are crucial for internal decision making, lender evaluation, and investor presentations. A robust model ensures the financial impact of the deal is clearly understood and risks are quantified. Uh, Funding sources for acquisition. How a company funds an acquisition has long-term implications. Cash reserves are the cleanest method. No debt or dilution, but they deplete liquidity, equity issuance, involves selling new shares to raise capital. This preserves cash but dilutes existing shareholders. Debt financing through loan or bond offers leverage but increases repayment obligation. Hybrid approaches like leveraged buyouts combine debt and equity for a balanced risk profile. Each method affects the company's balance sheet, cost of capital, and control structure differently. Choosing the right funding mix depends on the deal size, financial health, market conditions, and strategic goals. Moving further to the next slide, which is regulatory approval required in India. Acquisition, especially large or cross-border ones, require clearance for several regulators. The Competition Commission of India, which is CCI, ensures the deal it doesn't create monopolies. SEBI oversees deals involving public companies to protect investor interests. The Reserve Bank of India, which is RBI, plays a role in deals with foreign exchange implications. The Ministry of Corporate Affairs (MCA) handles compliance with company law. Finally, the National Company Law Tribunal, which is NCLT, approves schemes of arrangement. Internationally, acquirers must also navigate local measures, control laws, delays, or rejections can derail deals. So, early legal planning and regulatory engagement are essential. Now we'll see the case study of Facebook acquires WhatsApp. In 2014, Facebook acquired WhatsApp for $19 billion, one of the largest tech deals ever. The goal was to secure dominance in the mobile messaging and expand its user base globally. WhatsApp end-to-end encryption and a loyal user community added long-term value. Facebook allowed WhatsApp to operate independently post-acquisition to retain its culture and user trust. The deal faced privacy and antitrust scrutiny in several countries, but was eventually cleared. This acquisition showcases how a strategic friendly acquisition can unlock global market access to strengthen a company's ecosystem without immediate integration pressure. Moving further to the next case study, which is Microsoft acquires LinkedIn. Microsoft's $26.2 billion acquisition of LinkedIn In 2016, our strategy was to combine enterprise software with a professional networking to integrate enhance LinkedIn's reach through Azure and Office 365 while adding value through Microsoft's ecosystem. It was a friendly deal, and both brands continued independently with thoughtful synergy planning. The focus was on data, cloud, and AI-driven solutions. This acquisition is often cited as a textbook basis of strategic alignment, smooth integration, and long-term value creation. It helps Microsoft reposition itself from a software giant to a productivity and cloud powerhouse. Now we'll see hostile takeover. Vodafone and management. The Vodafone management takeover in 2000 was one of the most iconic and controversial hostile acquisitions in history. Valued at $183 billion, management initially resisted, but Vodafone appealed directly to shareholders, bypassing management. This aggressive approach succeeded, setting a precedent for shareholder activism. The deal created one of the largest telecom firms in the world, but also raised significant debates about ethics, governance, and national interest. The case is often used in business schools to study hostile takeovers, shareholders' rights, and the balance between strategic income and stakeholder impact. Moving further to the next slide, which is role of investment bankers. Investment bankers are crucial players in mergers and acquisition ecosystem. They guide companies through the entire transaction from target identification to deal closing. Their roles include advising on deal strategy, conducting valuation and financial review, and ensuring regulatory compliance. In hostile deals, they also help devise takeover defense strategies or exhibit operating tactics. They bring market intelligence, connect buyers and sellers, and negotiate terms. Given the high stakes and complex processes, their expertise their expertise is vital for ensuring that the deal is financially sound, legally compliant, and strategically aligned. Essentially, they are architects and engineers of the modern acquisition bridge. So, proceeding towards the next slide, which is acquisition versus organic growth. When companies aim to grow, they generally choose between two broad paths: organic growth or acquisition. Organic growth is gradual. It comes from increasing sales, launching new products, or entering markets incrementally. It's stable and controlled but slow. Acquisition, on the other hand, offers a rapid expansion, new market technologies, customers, all in one mix. But they come with the risk, integration challenges, cultural mismatches, and financial strain. Choosing between the two depends on your company's risk appetite, financial strength, and strategic urgency. Some companies even blend both approaches, growing organically in stable areas while acquiring to disrupt or diversify quickly. Moving further to the next slide, which is cultural challenges of in acquisition. One of the most underestimated risks in acquisition is cultural clash. Even if the financial and strategy align, differences in leadership styles, communication, work ethics, or organizational values can derail integration. For example, a hierarchical company merging with a flat structured startup can result in confusion and resistance. Communication gaps, lack of inclusion in decision making, and conflicting media practices can lower morale and productivity. Employee resistance is common if the changes is not managed with empathy. That's why cultural due diligence is just as important as financial due diligence. Addressing soft issues early is essential for a smooth post-deal transition. Moving further to the next slide, which is post-acquisition integration. The success of an acquisition is determined not at signing, but in the integration phase. This involves aligning people, systems, structures, and processes. System alignment means integration, IT, finance, and operational platforms. People integration involves harmonizing HR policies and uniting teams and aligning compensation. Process harmonization ensures workflow consistency across companies. Structural realignment defines new hierarchy and reporting structure. This phase is complex and time sensitive. Communication is the employees must understand the change and their role in the new setup. A detailed integration roadmap, KPIs, and feedback mechanism help track progress and avoid confusion. Now we'll see synergies expected versus achieved. Synergies are the financial and operational benefits expected from a deal, like cost savings, revenue boost, or shared technology. But often, the synergies projected on paper don't match the results delivered post-acquisition. This gap can result from overestimating benefits, underestimating cost, or poor integration. For example, companies may assume overlapping functions can be cut, but if teams can't collaborate, those cuts reduce performance. That's why synergy assumptions should be tested with real scenarios and benefits tracked through KPIs. Transparency with stakeholders about what's achievable and how. It's crucial to manage expectations and maintain credibility. Moving further to the next slide, which is risk in acquisition. Acquisition carry many risks, financial operations, legal, and cultural. One of the most common is overvaluation. Paying more than the target is worth often due to poor due diligence or competitive bidding. Cultural clashes can disrupt teams and cause challenges. Poor integration can result in redundant systems and confusion. Regulatory delays can halt progress or even cancel deals. And finally, financial strain. Taking on too much debt can hurt liquidity and investor confidence. These risks aren't reason to avoid acquisition, but to manage them proactively. A structured risk assessment plan should be part of uh, every merger and acquisition theory. Now we'll see the summary of acquisitions. To summarize, the acquisition are powerful tools for transformation, but they come with significant responsibility. They allow rapid market entry, competitive advantage, and product or tech acquisition. But success depends on three things. One, thorough due diligence and accurate valuation. Two, a solid execution plan, including cultural and system integration. And three, continuous monitoring of synergies and risk. Acquisitions are not just about signing deals, they are about creating long-term value. When done right, they can catapult the company forward. When mismanaged, they can destroy value quickly. So strategic clarity and discipline execution are key. Now we'll see what is corporate restructuring. Corporate restructuring is the process of reorganizing a company's structure, ownership, operations, or finances. The aim to improve efficiency, reduce risk, or respond to financial distress. Unlike merger and acquisition, which typically involves external parties, restructuring is often internal. It can be proactive, like adapting to a digital future, or reactive, like cutting costs during a crisis. Types of restructuring include financial, operational, and organizational changes. Think of it as a reset button for the business. It's about realigning resources to meet new ways or recover from challenges. In today's rapidly changing market, restructuring is not just a survival, it's first in relevance. Now we'll see the need for restructuring. Why do companies restructure? First and the most urgent reason is financial distress. When the business is losing money or buried in debt, the second is performance enhancement. Streamlining operations to improve margins. Third, market adaptations. Responding to industry shifts like new technology or regulations. Fourth, unlocking value. Reversing underperforming units or refocusing on core strength. For example, during COVID-19, many firms restructured to stay afloat, while others used the crisis to reposition themselves. Restructuring allows companies to become leaner, more agile, and more focused, qualities that are essential in volatile business environment. Moving further to the next slide, which is organizational um, restructuring, which is one of the types of restructuring. Um, Organizational restructuring involves changes to internal systems and structures. It may include modifying hierarchy, flattening layers to speed decision making. Decentralization pushes authority to regional or unit roles for agility. Role redefinition clarifies duties and avoids duplication. Cost-saving initiatives might involve staff optimization or automation. The goal is to improve communication, collaboration, and efficiency. However, this often impacts employees, so change management is essential. Clear communication, retaining retraining the leader and leadership alignment are crucial. This type of restructuring strengthens internal capability to make the organization more responsive to both opportunities and threats. Now we'll see the next type of restructuring, which is financial restructuring. Financial restructuring focuses on the capital structure, equity, debt, and liabilities. Companies may issue new equity to reduce debt or swap debt for equity to improve liquidity. It's often used by firms under financial stress, but also by healthy firms looking to optimize capital costs. For example, a company may replace high-interest loans with cheaper long-term bonds, or it may sell assets to raise cash and pay off liabilities. The goal is to create a sustainable balance between risk and return. Lenders, investors, and regulators must often be involved making this process both technical and highly strategic. Now we'll understand the corporate restructuring. Corporate restructuring is a strategic initiative, not just a reaction to crisis. It involves major changes in ownership, operations, or financial structure to improve performance. For example, a company might divest a non-core division, reorganize its debts, or even alter its leadership structure. Restructuring can help revive a struggling business or repositioning a strong one for future growth. It's critical in merger and acquisition scenarios too. Acquiring firms often restructure the target post-acquisition to align operations, whether done proactively or in disguise. Restructuring is a powerful tool to unlock value, reduce waste, and enhance competitiveness in the dynamic industry. Moving further to the next slide, which is operational restructuring, streamlining efficiency. Operational restructuring is all about improving the company's internal efficiency. This can mean optimizing the supply chain, re-engineering processes, automating automating repetitive tasks, or outsourcing non-core functions. The aim is to reduce cost and boost productivity. For example, a manufacturer may shift to just-in-time inventory systems, while a service firm may automate its CRM workflows. Execution requires setting clear performance indicators, which is KPIs, and continuously monitoring outcomes. It's not just about cost cutting, it's about building a more agile, responsive organization that can scale better and adapt faster in changing market conditions. Moving forward to the next slide, which is spin-offs, creating new value. A spin-off occurs when a parent company separates a division or business unit to form a new independent entity. This helps both companies focus on their core strengths. For instance, eBay spun off PayPal to let both businesses pursue distinct strategies. One in e-commerce and the other is digital payment. Shareholders often benefit as they receive shares in the new entity. Spin-offs are typically tax efficient and can unlock a hidden value that wasn't fully appreciated within the larger conglomerate. There are strategic moves. There are strategic moves that promote growth, improve valuation, and enhance operational clarity. Now we'll say divestiture years, strategic sales. A divestiture year is a sale of a business unit subsidiary. subsidiary or asset that no longer align with the company's strategies. Companies may divest to raise capitals, reduce debt, or sharpen their focus. It can also be a regulatory requirement post-merger and acquisition. For example, Tata Motors divested its defense unit to focus on passenger and commercial vehicles. While it may appear like downsizing, divestitures are actually growth strategies in disguise. They allow firms to streamline operations and reinvest in high-growth areas. A successful divestiture can re-energize a company and clarify its long-term directions. Moving further to the next slide, which is equity carve, farm house, partial sales for capital, and equity carve-out occurs when a parent company sells a minority stake less than 50% in a subsidiary via initial public offering, which is IPO. This lets the parent raise capital while retaining control. Carve-outs offer three key benefits. First, they generate funds without full divestment. Second, they unlock the subsidiary value in the public market. And third, they often act as a precursor to a full spin-off. For investors, it provides a chance to invest in a focused business unit. For management, it gives accountability and performance to public speaking. Carve-outs are a smart way to monetize without losing strategic oversight. Now we'll see debt restructuring over financial crisis. And debt restructuring is a vital tool for companies under financial distress. It involves renegotiating terms with lenders to ease repayment burdens. Common methods include extending loan maturities, lowering interest rates, or even partial debt forgiveness. The goal is to avoid and keep bankruptcy keep the loan winners alive while working on the turnaround. It requires negotiation with stakeholders and must be backed by a credible recovery plan. Debt restructuring can also boost investor confidence and provide breathing from room for strategic adjustments. It's a critical step in corporate recovery and must be handled with financial discipline and transparency. Now we see bankruptcy protection, Chapter 11, 3 US. In the US, Chapter 11, bankruptcy allows companies to reorganize under court protection without shutting down operations. This legal process gives business a chance to restructure their debt and operations while staying afloat. It differs from Chapter 7, which involves liquidating assets. Chapter 11 is often used by airlines, retailers, and manufacturing firms under distress. The company proposes a reorganization plan to repay creditors over time. This creates an opportunity for a fresh start. While India doesn't have Chapter 11, we have similar mechanism under the Insolvency and Bankruptcy Code, which is IBC. The idea is the same: protect viable businesses while resolving financial stress. Moving further to the next slide, which is corporate turnaround strategies. Turnaround strategies are focused efforts to revive a company facing decline. They typically begin with identifying root causes, whether it's poor leadership, unprofitable product, or inefficient operations. The next phase is cost cutting, streamlining process, and reducing non-essential expenses. Then comes strategic shifts like changing leadership, rebranding, or launching new products. Finally, companies must work to restore confidence among investors, employees, and customers. Quick wins help build momentum. A successful turnaround transforms not just the balance sheet, but also the company culture and brand image. It's a second chance for survival and long-term growth. Now we'll see the case study of a Tata Group restructuring. The Tata Group has been a textbook example of strategic restructuring. Over the years, it has merged businesses for synergy, divested non-core assets, and focused on high-growth sectors like digital and renewable energy. Governance reform and leadership changes also played a role in aligning the group's vast portfolio. These restructuring efforts have made Tata leaner, more agile, and globally competitive. Whether it was consolidating Tata Steel Europe or revamping Tata Digital, the group has shown that periodic restructuring isn't just about fixing the problems, it's about staying ahead of the curve in a fast changing global economy. Now we'll see the next case study, which is Jet Airways turnaround attempt. Jet Airways, once a premier airline, filed for bankruptcy in 2019 due to mounting debt and operational losses. A consortium led by the Jarin Tarlok Group proposed a revival plan, settling debts, restructuring operations, and resuming flights approved by the NCLT. The plan reflects how distressed firms can attempt recovery through financial restructuring and asset sales. However, Jet's journey also highlights the challenges reviving operations, regaining market share, and rebuilding brand trust. This case is a cautionary tale of mismanagement, but also a lesson in how structured turnaround strategies can give even failing companies a shot at redemption. Now we'll see the pivotal role of private equity in corporate restructuring. Private equity (PE) firms plays a crucial role in restructuring, especially for companies under financial distress. This firm brings not just capital, but also strategic insight, operational expertise, and governance reform. They often acquire underperforming businesses, turn them around through cost optimization, leadership changes, and business model redefinition, and then sell them at a profit. PE firms focus on value creation, tightening control over finances, enhancing productivity, and sometimes breaking the company into parts for better purpose. Their objective is to maximize return on investment while stabilizing and growing the business. Thus, PE is often the catalyst for corporate revival. Now we'll see key players in corporate restructuring. Successful restructuring is a team effort involving multiple stakeholders at the center in company's management, which drives strategic planning and operational execution. Investors and creditors fund the businesses and must support restructuring plans, especially when debt renovation is involved. Legal and financial advisors ensure that the changes comply with regulatory requirements and align with best practices. Finally, regulators like NCLT or SEBI oversee the process and protect stakeholders' interests. Each player has a distinct but interconnected role. If any party is misaligned or uncooperative, the entire restructuring process can fail. Clear communication and stakeholder trust are essential for success. Moving further to the next slide, which is restructuring distress versus growth. Corporate restructuring can serve two very different purposes, which is distress recovery and growth strategies. Distress restructuring is reactive. It's triggered by financial trouble and focuses on reducing debt, cutting costs, and stabilizing the company. Speed is critical. Growth restructuring, on the other hand, is proactive. A healthy firm may restructure to scale up, tap into new opportunities, or pivot strategically, like entering digital markets or spinning off a high-performing unit, while the tools, divestitures, carve-outs, operational shifts may be the same. The mindset and timing differ greatly. Recognizing the context is used to apply the right restructuring model. Now we'll see the challenges in corporate restructuring. Restructuring is a complex and often turbulent process. The biggest hurdle is resistance to change from employees, unions, or even management. Legal and regulatory hurdles can delay or derail plans. Financial constraints, especially in distressed companies, limit flexibility. And then there's poor communication, which creates confusion, rumors, and low morale. These challenges can make even well-planned restructuring efforts fall apart. That's why strong leadership is essential. Leaders must communicate clearly, act decisively, and align all departments. Transparency, stakeholder engagement, and realistic timelines are the foundation of any successful restructuring effort. Now we see benefits of successful restructuring. When executed well, restructuring delivers powerful long-term benefits. First, it improves profitability by reducing inefficiencies and cutting redundant costs. Second, it enhances operational efficiency, making a decision-making faster and the process smoother. Third, it increases stakeholder value by unlocking hidden potential and boosting market confidence. And finally, and finally, it builds long-term sustainability by aligning the business with future goals, technologies, or customer needs. Restructuring isn't just about fixing problems, it's about repositioning the company for growth, competitiveness, and resilience. It's one of the most impactful tools a business can use to transform and thrive in fast-changing markets. We have now seen how mergers, acquisitions, and restructuring aren't just financial transactions, they are strategic levers for growth, survival, and transformation. Each move must be backed by clear objectives, robust analysis, and effective execution. Whether it's a horizontal merger or consolidated market share, an acquisition to gain innovation or a restructuring to streamline operation, these are conversations that can define a company's future. The key takeaway in this success is merger and acquisition and restructuring depends not just on strategy but also on people, culture, and integration. With the right alignment, these tools can unlock exceptional long-term value. Thank you so much.